So I hope what's come across here is a sincere belief in the direction that we're going. Every time I see those videos, even though I've seen them a lot, I get motivated. Listening to the story again today, I truly believe that we have the right team with a plan that's ambitious but achievable, and also considers what is the optimal risk-adjusted path for our shareholders, is realistic and looks at the risks. So what have you heard today? Near term, we're going to reduce risk. We're going to dedicate all our cash flow to reducing leverage, and we're going to de-risk. At the same time, we're still going to be building the business and capitalizing on the momentum. We're going to grow profit. We're going to capitalize on the servicing momentum that George described so well. Continue that, grow that, do more business with more clients, more profitably, improve our value proposition. We're going to create a leading asset manager. We have the foundation for it. That's something that's still to be more precisely defined going forward, but it's something we're definitely pursuing. And part of profit is not just the revenue side, it's also what Annette talked about, which is becoming more effective, becoming more technological, becoming more cost efficient. But long term, we do this in the same way. We become operationally excellent through tech, through getting the right people in the right places, working together with a common goal. Client focus. There is nothing more powerful than investing in a client relationship and seeing it rewarded with business. It's worth repeating. We win 50% of new business. When we go to an existing client and ask them to do a new piece of business with us, either the same thing in a different market, either upsell or cross-sell or something, more than 50% of the time they say yes. Getting more clients, as George is doing, getting into the funnel means we increase that recurring, sticky revenue base, which is ultimately very good for us and our shareholders long term. Client centricity, capital light. Over the near term, we have a wonderful, big back book that we can extract cash from. That flexibility is what allows us to delever rapidly, but ultimately long term pivot to a capital light model. In concluding, today, tomorrow. I love these slides. Today, we're a traditional large-scale debt collector in 20 markets. Tomorrow, we want to be a debt resolution platform that's tech-driven. Today, we're 100% debt-funded pipeline investor. Tomorrow, we want to be a large-scale asset manager dealing in granular credit assets, funded primarily by third-party capital across all of Europe. What does this all mean? Higher quality earnings. More earnings, higher quality earnings, greater recurring nature to our earnings. We're delivering, and we're going to deliver. So with that, I think we're going to have a group Q&A. Right, Emily?
Definitely.
So I asked that all my partners come up to the stage. And now you guys are also going to have an ability to grill us in the room, as well as I'm sure there's a lot of questions from the, I think, 600 to 700 people who are watching, right, Anna? Yes, almost 700 people are watching on the live feed.
They're pouring into my iPad, so
Are
yeah,
they?
we'll see. Yeah, so we'll see how much we're actually gonna cover. But for you in the room, if you don't want to submit via the QR code, you can raise your hand. It's a fairly big room, so we ask you to stand up and wait for the microphone so everyone can hear your question. And while you gather your thoughts together, Andrés, is this Intrum 2.0, 3.0?
That's a good question. Well, we've been doing this for 100 years, so I don't know what .0 it is.
100.0?
Maybe 100.0. But the whole point of it is that we'll have a 4.0, 5.0, 6.0 if you want to start with 1.0 now or 2.0 now. We need to continually develop. We've been doing this for a long time. What I love is the fact when I look at my four partners, two are new in their seat, and one is completely doing his business in a different fashion going forward. That to me is putting people, talented people in the right seat and having the right plan. In my opinion, I'm incredibly confident of what we laid out today, and I'm incredibly proud of what the company does.
Do I see any hands in the room? Yes. We have one.
In the middle. Oh, there.
Hi there. Thanks for all the presentations today. My name is Rickard Strand from Nordea Equity Research. I would just like to ask you regarding the more capital light model. There are a few of your peers out there that have similar plans. I was just wondering if you have taken into consideration the increased competition as more debt collectors try to get more capital efficient.
Thanks for the question. I'm sure they have. Can you hear me?
Yes.
Yeah, okay. I'm sure they have similar plans, but as I said, I doubt they have the same value proposition.
Exactly correct.
I think, again, as I described before, the value proposition of the granular pipeline, our sourcing capabilities, and the writing capabilities, and the track record that we have at delivering, that is unique. That is impossible to replicate. So even if they move toward this capital light, which I understand why they want to do it, I truly believe that we have a value proposition which is unbeatable. And actually, we have had initial discussion with potential partners, and that actually support that assessment.
I'm sure one of the competitors you're talking about is Arrow. It's a very well-known transition from effectively someone who looked very much like us a few years ago to effectively a credit manager. They're getting out of consumer unsecured. They're getting out of servicing. They don't have the integrated proposition that we have, integrated business model that we have. And as Javier correctly said, they don't have that proprietary access to this granular assets. They don't have the 18-year track record of providing the return, which is the value proposition that the third-party investors that Javier just talked about are very interested in.
Anecdotally, right? We have, as was mentioned before, had quite a bit of inbound on this topic. And there are situations where people hear about competitors, etc. They reach out to advisors, and what they usually hear is, listen, if you want to do this and you want to do it right, you have to come to Intrum, because nobody has the foundation that we have, as Javier has laid out.
But even if you don't believe us, which you may don't believe us, I mean, at the end of the day, as Michael mentioned, we are not adding that into our trajectory. If we manage to deliver that, which I truly believe we're going to do it, that will be on top.
Do you want to follow up?
And also more specifically on the service side, I was thinking that there's going to be a crowd there as well.
What sort of crowd? What do you have in mind? You mean in terms of competition?
Yes, exactly.
I think, look, a combination of regulation and the economics of the industry is getting many players out of the way. We do know that a number of participants in this market, included, by the way, they are loss-making or they are very marginal profitable. They do not have sustainable business models. Intrum has a sustainable business model. We believe in the profitability we have shown, we can deliver it, and we have a sustainable advantage going forward. Footprint, client relationships, ability to originate, ability to continue delivering good results for clients. I remind you that we are in panels in many occasions with our competitors. Pretty much we win all the time. That's why we have the relationships and we keep having the clients, etc., etc., etc. So we think it will be less and less crowded for all the above reasons. We will fare very well.
One in the middle.
Okay, just let the microphone pass to the gentleman in the middle.
Yes.
There we go.
Yeah, hi. Thanks for very good presentations. Stefan Eriksson from Pareto Asset Management. I was wondering if you can shed some light on the Ophelos acquisition. Do you have any? Are you able to shed any light on the cost or the price for that? And then on follow-up, is it gonna involve a lot of redoing on the IT infrastructure, or is it more of an overlay? So that was both an operational and the cost. Thank you.
Absolutely. And I'll address the M&A element of it and the acquisition element. I'll ask Annette to address the more integration challenge and operational challenge and how it changes our landscape and our trajectory on the operational front. But I'll take a small step back and just say, remember the criteria I said for M&A. Everything says it has to build our business, particularly on the client side, or make us very efficient. This does both. And everything has to fit within our long-term deleveraging trajectory, which this is included. The purchase price that I'm about to tell you is included in these figures. But this one, and also eCollect, which is actually a very important recent acquisition that George talked about, invoice services, we looked at the specifics of the nature of the transaction. We, in each case, bought 100%, to be clear. Annette used the word invested in. We did, but we invested in 100% in partnership with the founders. So there was a structure where we paid something upfront, mostly to take out non-long-term investors, and isolate a relationship where we're partnering with the founders. And in Ophelos' case, we are paying a little bit under 30 million euros or so upfront, and then another 30 million euros or so over the next 3 years, a big part of which is KPI dependent. On eCollect, we paid about 6.5 million Swiss francs, and we are going to have a payment in 2026. Per will keep me honest here, somewhere between 10 or 15 to 20 million, I believe it is, that is also back-ended and also very KPI dependent. So we added the additional thing of we wanted to isolate our partnership with the founders. We wanted to create a deferred component and a contingent component to the consideration. But we own 100% of them, which is the transition over to a net, so that we can keep them separate, but also integrate them into our operations from a day-to-day perspective. And Annette, do you want to talk about how, particularly Ophelos, because it's a little bit more operational, how that's going to change our tech roadmap?
Can I also add, just because there's a lot of questions about Ophelos and the tech journey as you're embarking upon. One question is about what stage of integration Ophelos is with Intrum. Where does it stand today? And from there.
Okay, let's start then from that. You have seen a small trailer run. It's front-end driven, and we're getting into the customer service activities which we want to drive up, so we have a better way of working with our customers. But also, when we look at the whole tech landscape that we have, obviously that will influence a bit on how we're working with the new environment that we're getting into. Not all of them, but part of them. But then we also need to look at how do you modularize and set things up so that you have a good journey throughout the value chain that we have, but add on specifics on top of it. So this is currently what we are addressing. And again, the acquisition has not been approved by the antitrust authorities, so we have to go a little bit light until we get in there. There's a pilot ongoing in one of our countries, or in one part of our countries, which we're very much looking forward to see the completion of it.
And follow up, do you aim 100% evolution from phone calls to Ophelos enabled operations?
You can't do that at the end of the day. Because if we look at it, I mean, look at us. Younger generation, they're fully sort of on different apps, platform, and really want to use a digital interface. And also, depending on what type of debt collection we're looking at, you can do the easy stuff on this platform. However, if you look at the more severe cases and also elderly population, you can just look at your own grandmother or grandfather. Would they be on a digital platform? No. So this is how we have to balance it today, but also over time tomorrow.
Speaking of digital platforms, will you launch an app?
Tech is the important thing to take from how you want to drive it. So we will do what is best for us, but yes, there is part of that also.
Thank you.
Yeah.
And follow up, Annette. What is the cost of the tech journey? Well, maybe Annette, Michael, and Andrés. What is the cost of the tech journey? And is this cost included or embedded into the disposable liquidity waterfall presented by Andrés?
Do you want to start? Okay.
Again, every development, including the integration of Ophelos, as well as our tech roadmap as envisioned and communicated by Annette, is in these plans. So, and it is part of the calculation of my page when I looked at the liquidity that we're going to dedicate to reducing debt. There's no cost being excluded or anything like that. As Annette said earlier in your one-on-one, yeah, we're going to make investments which are going to have some low-hanging fruit initially, but some long-term, very fundamental benefits, all of which are here and beyond. By the way, this is only a 3-year plan. We expect these benefits, these measures to benefit for many years beyond that. I don't know, Annette, if you would add to that, please.
And on top of that is obviously that when you embark on a tech journey like this, it's easier to maybe understand where the cost side is, but actually the benefits is probably a lot more than what we see today. Because again, look at the landscape and the platforms that we are working with. We have 41 call centers. We have around 4,000 call agents in. And if you look at how we can transform that landscape, we can probably do a lot around it. And then also looking into how can we drive sort of the economies of scale, both taking into consideration the local regulations, but also understanding how we draw that out into making a bit more agile eco environment for us.
I mean, sorry, go ahead, Michael, please.
From my perspective, what's important to understand about this trajectory, and I tried to get it across, there's no silver bullet in this trajectory. It's really about execution. It's really about putting our heads down and executing every day, which also means that we realize small benefits every day. So there's no massive transformation, no big promises. This is putting the heads down. I know Andrés doesn't like the work. Grinding, working hard, and just delivering that trajectory step by step.
I don't know, I'm perfectly comfortable with those words. But anyway, just to preempt the question, again, no silver bullet. This is accelerating a path that we are already going. It's leapfrogging, I think, is the phrase that Annette held. And we didn't include the effect here because it's relatively recent. We haven't closed on it. But we did have a business case, obviously, when we agreed to it. And the consideration that I just mentioned to you, when we just look at improving our collections a bit, improving our cost a bit, has many, many, many multiples of what we paid for it. Obviously, to be executed upon. Execution is the big risk, but it is there. I actually think that's just scratching the surface, because that doesn't include anything in George's world, where we actually have a much better ability to win, or right to win even more business than we do today, because we have a better product. I think we can look at embedded collections as a service products put into our clients before we even touch something, but we're still going to get paid on it, which has tremendously high, it's a Trojan horse, so to speak. So I think there's so much possibility here, which is why when we got to know the Ophelos people, we're like, this is logical. We're the biggest debt collector in the world, and they're the only AI, tech-driven, however you want to say it, autonomous debt resolution platform. You put it together, you put their model with our data and our footprint together, tremendous value creation.
But we need to remember it's a journey. It's not done in 1 month. It will take some time to get through, and also realizing the values on how we integrate in a smart way.
Correct.
I have one last for your section. Annette, I just want to check if there's anyone in the room who is. Yes, there is. Here we go.
Thanks. Ermin Karic here from Carnegie's Equity Research. So maybe a question to start with, just given the decay you're expecting on your PI business and you're planning for an asset management business, how will you handle the collection capacity? Do you scale it down initially until you have the asset management commitment, or do you hold it, or how do you think about that? And maybe I can just take all three questions right away, so you don't have to hear from me anymore. Then another one, just on the Middle Europe, you talk about BPOs being up for tender and so on. How should we think about cash flows for that in the coming years, since those are usually some upfront payments? And then lastly, just on Southern Europe, since you have less than 5% growth assumed there, is that assuming the Haya will just be a run-off business, or are you assuming some other loss of mandate underlying there?
We'll take the BPO question first, if I may. The trend in the industry is not to make upfront payments. So none of the tenders that are out there have upfront payments. So the way to think about it is in the trajectory we have shown. There is no upfront payments to go with them. Regarding Haya, I think Andrés may want to...
No, I mean, and just on that point also, that's a form, Southern Europe historically was that way, because the industry in Southern Europe, as George described earlier, came out of a distressed financial system that wanted to externalize activities, which with all those benefits, but also raise some capital. So there was a capital orientation to buying those contracts. That doesn't exist anymore. That doesn't happen anymore. Southern European banks are in much better shape now. And in fact, older contracts, we're doing it right now in Spain with Santander, for example, older contracts that were originally paid for, that are coming near the end of their life, are getting extended at slightly lower margins, still very attractive, still within the parameters that George laid out, and being extended without any upfront payment. It's industrializing. That benefits us ultimately on the BPO. On Haya specifically, it absolutely is not a runoff. And I'll give you a perfect example. We bought it. It was a runoff in Cerberus's hands. It is not a runoff in our hands. Why? Because it brought us 2 clients, BBVA and Caixa. It also brought us others, Cajamar and others. Since then, what happened? There was a tender with no upfront payment for all the remaining real estate business that Caixa has with servicers that wasn't already in Haya. Well, who won it? Intrum did. We now have 100% of Caixa's real estate management business in Spain. That's possible because of Haya. That extends the life of what we bought in Haya. That means it's not a runoff, actually. And that's in here. And I would also remind you that even though we have 5% growth, everyone focuses on 5% growth in Southern Europe, it's still, even after this 3-year period, by far the biggest region. So it's not like it's maintaining what is already a very sizable business. What was the third question? The servicing capability.
Yeah, so I think on the capacity reduction due to the slowdown on investment, I'm not worried about. I mean, we are slowing down investments, but you have to realize, not in any year we invest on the same place. So, I mean, there are some markets that we invest on a given year, even in the past, and we have not invested in the next 2. So it's not that we have a committed capacity to our servicing units year after year. Our servicing unit, actually, and that's another benefit of our integrated model. They are being able to manage their capacity, balancing investment and servicing opportunities. So I'm not concerned with that at all. The only, you could say, I mean, even if we do a backbook deal, and I know it's not included in the numbers, we do expect actually also to keep the servicing of that as well. So I don't think there will be an issue with the capacity at all.
I mean, even if our proprietary collections goes from 13.5 down to, let's say, 10 or whatever, on the total collections of the 90-something, it's 3%, something like that. That's within variability of our operating platform.
the book value of Intrum goes from 41 to 30. But if we manage to pull the asset management, as Andrés showed in the last page, our total value under management will be from 40 billion to, let's say, 80 billion. So we actually plan to service more assets under management. It's not in the plan, but that's the idea.
Yes.
I saw more hands in the room.
Another question? Yeah.
Yes.
Yeah, good evening, everyone. So Jacob from SEB. A couple of questions. If we begin on third-party capital, will you be adding debt in different tranches to this structure similar to the Intesa SPV, or how do you expect financing to look like?
Well, the answer is under our own covenants, we have a limited capacity, or a fixed capacity, I should say, and Michael can talk to us better than I can, of having investing capital in levered vehicles. So if we're going to do something on a backbook deal, it might be in there, might not, because most of our investors that we're talking with will probably want some level of leverage, but we're looking at structural alternatives to make sure that we can do everything within our covenant and also they get the return they want. On a going forward basis, we have to do any kind of a capital partnership going forward on an unlevered basis as it relates to us, and there are structures that allow us to do that. And we're working obviously with professional advisors, Jakob, to ultimately put in place those structures.
And also goes a little bit towards disclosure, because in the past in our joint ventures it's been on a one-line basis. Obviously this is developing a business, changing the way we invest, and that would also impact our disclosure, and we would actually want and need to make that as transparent as possible, because we invest less but we generate a lot more valuable fee income out of that business. So that would be reflected, fully reflected.
This is not an isolated deal in XYZ market which gets thrown into JVs. This is a business line where we're dedicating and giving, as I think Javier said in his section, exclusively our origination capacity and our servicing capacity. So we're going to be much more transparent, as Michael says, and much more open about that development when it does take place.
I see that in the chat. So
he gave you like 10 questions, I heard.
Yeah, so I give you 3, and then we can come back to you if later on.
All right, I'll continue. So you stated portfolio investments will be 2 billion on a run rate going forward in 2024 and 2025 and 26. But how should we expect the run rate to be in the second half of this year? As I assume you have already won a certain contracts which you need to fulfill on. Yep. So.
No, I'll take that. We've talked in the past about a very clear envelope for the rest of the year, and if you take that on a quarter by quarter basis, the second half of the year is very consistent with that 2 billion per annum. So we invested more during the first half, but a lot of that was out of deals that we already won into the back end of last year. So it took a little bit of time to just wind that down, but it's going to be much reduced from a portfolio investment perspective during the second half. But maybe Javier, you wanna add to what I'm saying?
You're totally right. I think we do expect the second half to be in the run rate of 2 billion per annum, and it will be mostly dedicated to committed flows that we have to support our servicing business.
Correct.
All right. And then another thought. We have talked about your leverage ratio quite a bit, and we hear that FX is, giving quite a bit of headwind there. Have you thought about doing an FX hedge on your remaining debt in order to make sure you actually reach 3.5 times?
That's a very interesting question.
That's right.
So the reason we have a headwind in FX, it's actually not really something that's hedgeable or where it makes sense to economically hedge it. Our business and our balance sheet are 60% plus euros, right? But obviously we're based in Sweden, we report in Swedish crowns, which means that our balance sheet is translated at a spot rate, whereas our P&L is translated at an average rate. So if the FX stops moving, all of this catches up. It's just in any given quarter, you have a dislocation, particularly when the FX has moved a lot versus the euro. So that's something that's just inherent in the build-up.
Okay, another question in the room? Yes. Please.
Thank you. Patrick Bratelius from ABG. Just one question from me. Given you talked a lot about the cost base and automation, and you want to be more efficient, can you talk a little bit about the percentage of the cost base that is that comes from the personnel side and the need for personnel reductions going forward?
Michael can correct me. I'm going to talk about this in broad terms, but we roughly have a cost base of around 12 plus or minus billion SEK. Roughly half is personnel. And of that, 2/3 is operations and IT. So that gives you a sense for how it all breaks down. Am I roughly right, Michael?
I have nothing to correct.
Thank you. Does that answer your question?
No.
Okay.
The need for personnel reductions going forward, given that you automate your business.
Okay, so let me take that. So of the 6 billion, roughly 6 to 6.5 billion that's personnel a year, we're reducing at least 800 in the tactical cost program. A half to 2/3 of that comes out of personnel. The other comes out of other things, contracts, other things. So you already have a sense there that we're reducing, I don't know, 8, 9, 10%, something like that. I think that number will ultimately be higher. That does not contemplate the automation and the road and the technology roadmap that Annette talked about. That will add further need to adjust our people and our granular operating model, how many people we do and what we do, actions we take. That's not in this. That,
bringing in the new process and the tech around it, then that's when you then offload the resources that no longer is required. So that will come later on.
I would also encourage you to think about this as a very dynamic equation, because we're growing the business at the same time. So effectively what's happening is our business is ultimately about intensity. So how you contact your customers, how we contact our customers, and that we do it with the right channel for them. So if we're able to win additional business, if we're able to pivot towards asset management, that gives us an additional pool. So which means that if we have more effective instruments, right, our existing workforce can focus on more value-added tasks. So it's a dynamic equation between the growth and where the cost base is. But ultimately it translates into margin. And you can see from our trajectory that we plan to expand that by at least 7 percentage points. So that gives you a sense, depending on exactly how these lines move, what we have to do to our cost base to get there.
And then also on top of that is that you have a churn in the call centers that you can also use while you're transforming.
That's a very good point.
Do we have
Other
another
questions?
question?
Thanks.
Otherwise, I'm thinking Jacob, since... Okay, sorry, no, there's there's another
No,
one.
that's another question. You
Yeah.
don't get to dominate, Jacob. We'll come back to you.
We'll get back to you later.
Thank you. Eric Andron here from Carnegie. I just wondered, in your new business, what is your expectation of your future cost of funds for the business?
That is a very good question. So when we built this trajectory as we presented it, we assumed for any refinancings that we would face the current market rates, right? Call it around about 14% for the Eurobond side of things, and you can see the other ones on the screen. But as I said before, there is an upside as we de-risk and de-lever that comes down, but we haven't baked that into our projections. It's an upside.
Yeah, as I said in my section, we haven't assumed any more normalization of the market, and we haven't assumed any lowering of our cost of leverage due to the deleveraging. We've maintained all of our costs whenever the existing maturities come up to be refinanced at market rates. But again, if we choose not to, and we choose just to use all of it, which is our intention to largely and almost entirely use debt cash flow to reduce debt, we don't have to do anything in the marketplace till the end of 25.
So it's blended 14% across the board then?
Really on the Eurobonds, it's 14%, and some of the others minor components, they're a little bit lower, but they're at current market rates.
Thank you.
So I just want to pop in here with a few questions, because Patrick is kind of following up with the investments within IT. So he's wondering, these investments are completely included in the numbers till 2025. It's not going to be any surprises within the area. Yes or no?
Actually, I mean, all of your activities are included in our 3-year plan, all the way through 26, right?
Yeah, it's 26. What we know today, but obviously we have also the benefit now when we get offers coming in, looking into and revisiting it.
So
And then also from a pure, CapEx point of view with the investment side, there's also upside coming in.
So you can tell Patrick,
Yeah.
we don't expect any surprises.
no surprises. And I also want to, we did cover this earlier, but Shell maybe wasn't present at the time. The dividend intended to be paid in November is still due.
Absolutely.
Yes.
Well, absolutely.
Anyone else in the room? Yes, Jacob. Wait for the microphone.
Yeah, so my next question is to actually George. So looking at the margin on service contract signs in H1 this year, it's substantially higher than your back book. You mentioned the cost program will help with some margin expansion, but are there any other main drivers, for example, reduction in cost to collect, or have you changed any of your pricing?
I think a combination of all of the above is optimizing the collection strategies is one, and the selection of what business we pursue. Because at the end of the day, there are businesses out there and contracts out there that have higher or lower margins. So we go to the ones that are more suitable to us. The benefit in the contracts we have signed this year, for all good purposes, and the margins we have shown for this year, significantly higher than the stock, is on the current cost base. The cost income, the cost program will come as a boost in most cases you have seen.
Okay. Then I'll take some from the email as well. Petros is wondering why one Intrum didn't make any sense.
I didn't say it didn't make sense, to be clear. It made tremendous amount of sense when it was put in place several years ago when we largely ran the 25 or 6 markets we were in then very independently. A centralization of management makes sense. A centralization of direction makes sense. A complete centralization of operations does not. And also, you know, we also didn't execute as well. The center didn't deliver as much for the local, and it also created a lack of empowerment, a lack of disenfranchisement at the local level. What we're going back now, and by the way, we consolidated those benefits, and now we're going to a more balanced business model where the local management teams feel empowered to make decisions. Our customers and our clients are in the local markets. So we need to allow people who run businesses in specific markets to be able to run their business and make decisions. We need to give them the tools to be effective. Having someone like George sit above the commercial gives them tools, gives them information that they get from other markets. There wasn't historically a cross-fertilization. There wasn't as much ownership and accountability local. There wasn't as much on things that are important like IT, ops, commercial, investing, and finance. Cuts across the entire thing. Those are where we need to have experts, really capable people delivering for the markets and giving them greater tools to understand how they can improve their businesses. The performance scorecard that Annette talked about earlier, we didn't have one. Markets didn't actually know why they were in collecting at a certain rate and the other market wasn't at that rate, or was at that rate. We have 3, just to name 3 great businesses, Switzerland, Portugal, Greece, just to name 3 of our best performing businesses. Well, Spain, Italy, and Germany didn't have access to those numbers. So what we're trying to also do is bring people together, but empower our local people with information to create a continuous improvement and performance management culture.
Annette, kind of following up on the same subject, have you seen any opportunities using AI? I think your answer will be yes, so elaborate on how in the collection process.
First, before I get into that, I think it's also important to understand that we're in a regulated market which looks a little bit different locally. And that's also why one Intrum didn't work, because you need to understand what the differences are before you can actually draw on the economies of scale of it. I think one of the most obvious one, and this is also why we are going to work with Oflos, is obviously the customer self-service processes that we need to get into. We are making a lot of calls which are not effective and that we need to sort of take out. There's also a lot of document handlings. There's all along the step you can actually take out a bit just by looking into how you can automate it more. But the biggest one is really looking into how we face the customers.
I mean, think about our business model. We're 10,000 people that sit in between 80,000 clients and more than 25 million customers. If we can use technology to make that interaction more efficient, more effective, more clear, it can only benefit our clients and our customers. I think AI is not a term I necessarily agree with because I don't think it's necessarily intelligent per se. We can get into that, but that's not for today. That's not for today. But I do think that the customer interactivity, but also the decision science behind their model and figuring out what actions are positive or not, those 130 million actions, we're going to become more efficient, more targeted. You can get a text in the morning because your profile says you're a morning person and you like text. I get a phone call. I get a phone call because I make more phone calls or am more active generally in the afternoon. What Ophelos also does to us is it allows us to focus on every individual, not batches of individuals, and also be much more targeted and efficient and only do actions that are likely to elicit a response that's NPV positive. A large portion of those 130 million actions don't yield a result. Just eliminating them is a massive benefit.
But I think at the end of the day, it's also looking at the human interaction in it, because we know we have automated things. We are looking into part of the AI already from the beginning. The problem is how you apply it and actually how you're sitting on top of it, because you can't just interact and add on an automation without understanding how it works. We see that we actually are doing things because we're letting the machine rule rather than us ruling. So that interaction needs to happen as well. That's also why it's important to have this, have the co-work between local countries and also sort of people sitting on the central levels. And that's also why you cannot go either way. You have to work and be balanced in the middle of it.
We have a question in the far back. Yes, sir.
Yeah, thank you. I'm Bengt Ecke from AFA Insurance. May I ask you first, like for like, if unemployment goes up in Europe with 1 percentage point, what is the effect on you? Because you have so much statistics for 100 years, you must know. That's my first question. And I guess I forgot my second one.
Do you want to address it, Michael? Do you want to? I can as well, please.
Let's start. There's two sides to that equation, right? Unemployment goes up. Obviously, that is usually accompanied by other macro indicators as well, which means on the back of that, or driven by that, we get more inflows. But at the same time, we probably find it a bit more difficult to collect, so it gets a little bit more expensive, and we might collect a little bit less in an individual claim. And exactly depending on where you are in that cycle, you have a minor negative to a minor positive. I think that is the best way of explaining it. I don't know whether you want to add to that.
You're absolutely right. That subsequently to any increase in unemployment, typically there's unpaid claims, which then leads to an increase in servicing, et cetera, et cetera. But there is a limited, a more difficult time or cost or effort and cost to collect. There's no doubt about it. But you bringing up unemployment is a very important thing. You noticed my market statistics didn't have unemployment. This crisis is very different than those of us who remember the last crisis. The last crisis was an unemployment crisis fundamentally driven by an asset bubble that bursts. This crisis is not that way. People have jobs. They just don't have enough income. Their income is falling short. So that's one of the reasons I think when you look at the shape of the curve of what's coming, it's going to be very different. Banks are in better situation today. The problem isn't accelerating as acutely, and there isn't an unemployment crisis, but it is coming. There's no doubt about it. And so what it's going to be flatter for a while. It's going to be a greater lag, and we're in the middle of that lag right now. Then it's going to be steeper, because as soon as one or two do it, there's going to be a flow, because the environment over the last 15 years is that sellers are sophisticated. There's no stigma around selling as there was 15 years ago. Then it's going to be very steep, and it's not going to reach the peaks of last time, because sellers are sophisticated, and they're always looking for the right partner in doing this, and that's where we're going to benefit from this, and that is coming, absolutely.
Studies we have done, not pan-European, but we have done a number of markets and looked into the other realities that unemployment by itself may not affect anything, because there are other things in between. For example, what the fiscal policy in the various markets will be. I mean, what we have seen in the COVID, in the pandemic, is the biggest number of people not doing anything, and the highest number of collections, because the state steps in with fiscal policy benefits, etc., etc., etc. So there are quite a few, I think, elements there that have to do with the monetary policy chosen by the central bank, which was expansive for years, with the fiscal policy in the various countries, etc. But to emphasize again, in reality, the Intrum model is pretty much weatherproof, in the sense that we have stock business in the hundreds of billions, by the way. I think we showed here 1 trillion only external. And in the stock business, effectively what matters is the better the economy, the better the recoverability. But even if the economy is not that good, and this creates, assuming there are no government interventions, and there have been the last few years, and you have decreased disposable income, etc., you have new cases that pretty much mitigate what you have lost in recoverability. I see the model as pretty much weatherproof. And if you look at the revenue pace of Intrum in the last few years, with so much happening around Europe, positive and negative, I think this may be a good indication that what I'm saying is about right.
George, you make a very important point, because what we've talked to is really the like-for-like point. But if you actually apply it to Intrum, we operate in 20 countries in Europe, right? And they are at slightly different stages of what's happening in the macroeconomy out there. I know Andrés likes to call it a train, right? And if we look at how that train sort of winds through Europe, the UK is probably at the front. I mean, the crisis there is pretty deep. We're seeing people acting, we're seeing people in challenges, but we also see inflows and we see growth opportunities in servicing. And the end of the train is probably in Greece. They're coming out of the last crisis and they're doing very well. So our diversification also gives us a bit of a hedge against what you talked about, and that contributes to the stability that George just talked about in terms of our trajectory.
Okay, guys, we're coming very close to 5 o'clock, so I just want to bring some in here before we say thank you for today. Mark wants to know, I understand no dividends until the under 3.5 leverage. What about buybacks?
We are dedicating all our cash flow until the end of 25 to reducing leverage.
Mark, wait and see. And what about buying back bonds, Michael? Will or can you?
Look, I've very much talked about reducing net debt, and we'll obviously look at the appropriate ways and instruments that we have available at any given point in time. So we'll look at all forms of executing on that net debt reduction strategy.
Okay, last question. Susanne asks, or claims, culture beats strategy. With Intrum direction presented on what to drive for future, how does the board and the management secure Intrum cultural and behavioral commitment to change?
I think she's been sitting in on our board meetings. My chairman is sitting in the back. We have it's a well-known phrase, but also a slide that we use at the board, which is culture eats strategy for breakfast, lunch, and dinner. And it's true. You can't pre-prescribe everything, which is why I'm so excited about what we presented today. We have great people in great seats. We have great people running our markets, not without changes. We've made a fair amount of changes. We've already started a lot of these initiatives a year ago, and then we're working through them, and now they crystallize and come together in this plan. So we need to put the good people in the right position, give them the tools, and then let them run the business. You can't, and that's culture. And the culture is about collaboration, about performance management and performance focus, about working towards a common good for the company, about delivery. Delivery from the center is also delivery locally. That culture, if we do that, the plan is going to be slightly different than whatever we put on the page, but I'm positive it's going to be positive. I'm positive it's going to be up and to the right, so to speak.
As well, that's also a cultural
Absolutely.
carrier.
That concludes the Q&A. Thank you so much, everybody in the room, for your presence and your questions. For those who want to look at this broadcast again, it will be out on the Intrum Investor Relations website tomorrow. And for you here, there will be some mingle out and about just now. And yes, you will get you will get the final word. And for you at home, I'm sorry. I hope you have some good drinks for yourself. Now, Andrés, please.
No, listen, I just want to, first off, thank the team. I think, not just this team. You're seeing here the tip of the iceberg. There's a whole iceberg underneath. A lot of our senior management team is in the audience. A lot went into presenting this, but a lot more goes into actually what we do every day. It's the 10,000 people. Every person has that purpose. Every person contributes to what we're showing you, every single person. So I'd like to thank the team. I'd like to thank the board in particular and our major shareholders who are quite supportive. And then ultimately tell you that this is a journey. I've been asked indirectly, will the market recognize this, et cetera? I don't expect the market to just recognize it or rely on it just because we tell you it. When we start delivering on it, I do expect the market to recognize it and reflect it. But this is a journey. And I appreciate you sticking with us for exactly 4 hours and 2 minutes today. And I will even more appreciate those of you who are along the ride with us for the journey. And we will come back and you will have similar type transparency, honesty, and disclosure, and actually ambition going forward from us as a team. I promise you that. So thank you all for today, and look forward to our next interaction.